everyone. It's great to see you all. I'm Tracie Majors, an assistant professor here at USC, and I'm delighted with the wonderful assistance of one of our amazing PhD students, Catherine Brewer, to moderate this session. This final paper that we have today, a really interesting, rich, I found cutting edge and creative and having very important implications for practice paper, is titled, "Is Artificial Intelligence Making Audit Firms More Efficient?" Our presenter will be Anastassia Fedyk from University of California, Berkeley, and our discussant will be Robert Knechel from University of Florida. Anastassia, I'll now turn it over to you. We look forward to hearing about your super interesting and compelling work.
Thank you so much, Tracie. Thank you to the organizers for including us on the program, and to the anonymous reviewers for really excellent feedback that we have received so far. I also look forward to hearing Robert's feedback at the end, as well as any suggestions or questions that we might get from the audience. It's going to take me a moment to reshare once I get to full screen. It's a little bit of a glitch on my computer, but now it should be hopefully full screen visible. And this is joint work with Anastassia Fedyk at the University of San Francisco, James Hudson at the AI for Good Foundation, and Natalia Hinch at Drexel University. I believe both Tatiana and Natalia are on the line here today with us as well. And the question that we aim to address in this paper is the role that artificial intelligence has played to date in the audit process. Of course, artificial intelligence is really gaining prominence and commercial interest in the last decade. So since around 2012, we've seen an explosion in commercial investments in artificial intelligence. Firms are spending tens of billions of dollars per year on AI, and governments across the world, the US, China, the European Union, are all pushing for more research and development and more investment in AI. So there is an expectation that AI will be able to transform the business landscape. And there is some evidence in economics and finance that is happening across a variety of sectors. So firms are able to leverage artificial intelligence to grow larger, to increase their valuations, increase their sales, increase their market share. In this paper, we focus specifically on artificial intelligence in the audit sector, where we believe it is especially relevant and interesting for several reasons. First is that audit is exactly the kind of sector where we would expect artificial intelligence to play a role. Previous automation technologies have mostly focused on really low-skilled, manual labor, things like factory workers. Artificial intelligence, by contrast, aims to automate more human cognition tasks like prediction, like anomaly detection. And those are the kinds of tasks that are really prevalent in audit. And in fact, computer scientists have highlighted audit as one of the occupations that is considered most relevant for AI applications and most susceptible to potential automation through artificial intelligence. The second reason that audit is an interesting setting to study the implications of AI is that it's a relatively standardized, regulated setting where we get to observe detailed outcomes. So we see things like per audit fees, we observe what happens to those statements after the audit, whether we see restatements or whether we see adverse incidents of things like SEC investigations. So in this paper, we do three things. First, we want to actually see what does artificial intelligence skilled workforce actually look like in audit firms. Second, we observe whether it looks like artificial intelligence is helping make the audit process better. So are we seeing any improvements in quality? And finally, whether artificial intelligence is helping to make the audit process more efficient. So are we seeing any evidence so far of artificial intelligence potentially reducing the reliance of audit on human workers? Before I go into the detail of what we do empirically, let me be very clear about what we mean by artificial intelligence and how it differs from previous technological investments. Organization for Economic Cooperation and Development defines artificial intelligence as a machine-based system that can, for a given set of human-defined objectives, make predictions, recommendations, and decisions influencing real or virtual environments. As I mentioned, this differs from other technologies in that previous technologies have largely automated low-skilled, manual, often physical kind of tasks. By contrast, artificial intelligence automates high-skilled human cognition tasks, predictions, decisions, recommendations, detection, classification, and so on. Artificial intelligence, of course, can complement other technologies by processing data that can be obtained with other new technologies, such as, for example, drones. But the main aspect of artificial intelligence is that it can help make better predictions from data. How does that differ from other types of data analytics? That's also important. The main difference is that artificial intelligence techniques are more sophisticated. So whereas previous data analytics tools, for example, Excel or basic econometric or statistical regressions, were able to compute things like averages, visualize the data, run a simple linear regression. Artificial intelligence is able to model highly complex, highly non-linear relationships, thereby fitting the data better and being able to make more precise predictions. This also comes with more sophisticated processing of the data itself, meaning being able to process larger amounts of data, more unstructured data, and occasionally different formats of data. So now we're able to process visual data and language data. When we speak to audit partners at audit firms about their use of artificial intelligence, one of the use cases that gets brought up the most is optical character recognition. So this is something that would not be achievable with previous types of data analytics. And by contrast, it's not only feasible, but very widely deployed and scalable with artificial intelligence. How do firms actually invest in artificial intelligence? Well, there are three key inputs that we need to be able to deploy these algorithms. The first, of course, is data, the data that we're actually going to be making predictions based on. That largely comes from client firms, and auditors don't have that much control over how much data or what kind of data they're going to have to work with. So that's not something that audit firms necessarily invest in. The second key ingredient is computing power. So to be able to run these more complex algorithms on these larger data sets, we do need more computing resources. Computing resources have gotten better and cheaper in the last decade. That's why there has been this surge in applications of artificial intelligence. So these days, it's not really the main cost item. Instead, what auditors highlight to us as the main cost item and potential impediment to AI investments is having the trained human capital to develop those algorithms, to potentially adopt or test algorithms that are available from external vendors, and to train the workforce at the audit firm to actually be able to use and deploy those tools on individual engagements. So this is what we leverage in our paper. We'll look at whether firms are hiring AI-skilled human capital as a measure of the extent to which audit firms are actually investing in AI technology. We're able to do this using a unique new data set that comes from a company named Cognizant. It's a client relationship management company that collects and purchases individual employment profiles, or in other words, resumes. So they have just over 500 million individual resumes globally. And each one of them includes that individual's job history, any self-reported skills that that individual might put on their resume, the education, and anything else that might go on the resume, including publications, patents, awards, certifications, and so on. This data set is really neat for two reasons. First, it captures actual hiring and presence of AI employees rather than just audit firms' wish to hire. So other data sets such as job postings give an indication of the extent to which a firm might be interested in deploying AI technologies. But here we actually observe whether it's happening at each firm. And the second advantage is that this data set has really good coverage. So we observe over 300,000 individual employees at the 36 largest US audit firms, which covers just over 80% of all US-based auditors at those firms from 2010 to 2019. So we get to see almost everybody at the firm. We identify AI skilled labor by following the method that we developed with one of my co-authors in the current paper in a previous paper with Tanya Babina and Alex Hay, where we basically use the job title, job description, and any additional information like patents, publications, or words of an individual at each point in time to look for highly AI relevant skills. Those are AI relevant skills. Some of the highest ranked examples would include things like recurrent neural network and supervised learning, natural language toolkit, and so on. So if those terms appear in the job title or the job description or the publications or patents that are produced during that job, then we can tell that that person is an AI skilled worker. We supplement these detailed resume data with interviews of partners at audit firms that we've been conducting in the last couple of months. Have about a dozen interviews conducted so far to really get an understanding for what some of the applications of the tools that these AI skilled workers are developing may be. Let me give you a couple of examples of the actual job descriptions of these AI workers so that we can get a flavor for what they're doing at audit firms. So the first one uses tools like Alteryx, Python, R, Excel, and Tableau to conduct exploratory analysis and build machine learning models to evaluate audit and restatement features. Specific to audit, to restatement, and using machine learning to improve that process. Second individual in these examples uses very similar tools to build predictive models of fraud and corruption. Fraud detection is one of the most frequently mentioned applications of AI that also come up in our audit partner interviews. It's a very big area. Another one is anomaly detection, which we also see in this third profile. So identifying anomalies in financial transactions by clustering, and then also models, predictive models for accounts receivable, for sales returns. So these are also areas that come up frequently when we speak to auditors about where they actually see the highest use for these artificial intelligence tools. So things like fraud detection, anomaly detection, reading of contracts, of leases, and accounts receivables. Those are among the highest use cases. Who are these AI workers? We have a descriptive table here. So we see they are predominantly male, 70% of them are male. And they're similarly distributed across the hierarchy of the firm to the rest of the audit firms. So a good chunk of them are junior, about 57.5%. This would be basically their entry-level positions or individual contributor type roles. About a quarter are in middle management, and then around 18% are in senior management roles. Average age is 35 and a half, with an interquartile range from 28 to 41. So relatively young, but not very young, so somewhat experienced. Corresponding to these employees also having relatively high educational attainment. So only 38% of them end at a bachelor level, and many go on to postgraduate degrees, so with 31% holding master's degrees in areas other than business, mostly engineering type of master's degrees, 13% having MBAs, and 11% having doctorate degrees. So this would include PhDs. The kind of educational background in terms of major is split. So a large portion of these AI related workers come from technical backgrounds. So for example, 28% have degrees with majors in engineering and 15.5% in computer science. But many also come from business backgrounds. 22% with degrees in management, 14.5% majoring in finance, and so on. This mirrors what we hear from audit partners who highlight that the way that the artificial intelligence efforts are organized at firms is often in these innovation and transformation centers, where some of the managers or product managers would come with business backgrounds. Oftentimes they would be already audit partners that would then transition to these more innovation-based roles. So they would know the use cases where we would want to deploy artificial intelligence tools. And then many of the more junior employees who are working on actually designing and adapting these tools would come from more technical Audit employees are concentrated in just a handful of geographic locations across all firms. So the top 4 locations, basically the counties of San Francisco, New York, Washington, DC, and Cook County in Illinois, which includes Chicago, cover just over half of all AI-related employees. So these efforts are really centralized at the firm. They happen in dedicated centers, and then the tools are given to individual audit offices to use. That's what we hear from the audit partners as well. Tools are developed, tested centrally, and then there is often a mandate for those tools to be adopted across the board in audit engagements. Frequently, individual auditors tell us that they're encouraged, so strongly encouraged, to use at least 2 to 3 of these tools on each large client. Right, so let's take a look at what the effect of these AI investments actually is. So the first and main outcome variable that we look at is the incidence of restatements. So when a firm has recently invested in AI, do we observe an improvement in terms of that firm's audits leading to fewer restatements? So we look at AI investments in the previous 3 years, and then we predict whether or not each individual audit results in a subsequent restatement. And the audits issued in the current year relative to AI investments in the previous 3 years. And we see that previous AI investments do predict a decrease in the likelihood of restatements, material restatements, revenue accrual related restatements, and also an incidence of SEC investigations. These results are very robust, controlling for number of features of audit firms and client firms that have been linked to restatement risks in the past. And motivated by some of the excellent suggestions from our reviewers, we also take a deeper dive into these restatement results to see that these effects are present for both Big 4 and non-Big 4 firms. These effects are really coming from AI and not other related technologies. So consistent with some of the recent evidence that finds limited effects of generic data analysis tools when we use our resumes to measure investments in data analytics and software development, we see that these have very limited effects on restatement. By contrast, the more sophisticated AI investments do have a significant and very stable effect. We see that consistent with AI being a centralized function. It's really the kind of firm level AI investment rather than individual office AI hiring that predicts decreases in restatement risks. And it's really auditors AI and not their clients AI that has this effect. So we're able to leverage our resume data to also measure AI investments by client firms and include that as an additional explanatory variable that has much less explanatory power than the auditors AI use. Finally, AI use, of course, has increased over the course of the decade that we look at. And consistent with that, when we slice our sample into the earlier half and the later half, we observe much stronger effects in the second half of our sample. So from 2014 onwards, rather than from 2010 to 2013. I am almost out of time, so let me just really briefly show you some of the results on our kind of efficiency measures. So we look at 2 measures of efficiency. We look at the number of human audit employees at the firm, and we look at audit fees. So in terms of employees, we predict future changes in the number of employees based on previous investments in artificial intelligence. And we see that there is no effect in the first year or the second year, but once we get to 3 or more years out from AI investments, so for those few firms that invested early, we do see a significant decline in auditing employees. So a decline of about 3.5% after 3 years, which goes up to 7% after 4 years. We also observe a decline in per audit fees, so consistent with these technologies making the auditing process less kind of cost intensive for the auditor. We see some of those gains passed on to the clients in the form of lower fees. That doesn't mean that the audit firm doesn't take some of the monetary benefit for itself. Indeed, we see that the per employee fees are going up. So the decline in employment slightly outpaces the reduction in per audit fees. So the auditor is able, the audit firm is able to make more in terms of fees per employee. And I think I'm just out of time, so let me conclude. In this paper, we provide the first look at what AI skilled workforce actually is like at audit firms. See that they're male, young, they mostly have technical backgrounds, but with a good mix of business degrees as well to be able to guide technological implementation, and they're concentrated in a few key locations at each firm. We then provide large-scale empirical evidence of what the effects of this new technology are on both quality of audits, so to see a reduction in restatements as firms invest in AI, as well as efficiency. So AI adoption does predict a reduction in the workforce, but with a lag of 3 to 4 years, as well as a reduction in fees, while making more fees per employee. So our evidence suggests that so far, we're pretty early in the adoption process, but already we're seeing that artificial intelligence is helping audit firms deliver a better quality product at a lower cost. And thank you very much.
Thank you so much, Anastassia, for that interesting and really thought-provoking presentation. Robert, I'll now turn it over to you. We enthusiastically await your comments.
Okay, let me share my screen. Okay, come on. There we go. All right, well, I appreciate being invited to give a discussion on this particular paper. I'd like to thank Patty and the organizing committee and the people at USC for being willing to let me participate here. I also, on a more personal note, want to thank USC. Sometime today, my son is taking his last advanced economics exam and will be graduating. So, which means I don't have to write any more checks to USC. Any event, Anastassia, this paper is a really interesting paper. I really enjoyed reading it. I've been doing this a long time. And basically, we know almost nothing about the factors of production in the audit market. We know even less about the market for the factors of production. And so I think this is a really interesting paper to try to give some insight into a part of auditing that has really gotten very little attention. And as you noted, it's probably because there isn't a lot of data. Before I get into my formal remarks, let me just make some general comments. Audit firms are huge, particularly the Big Four. They have huge legacy costs. I mean, you're talking about firms that worldwide have $40 to $50 billion in revenue, tens of thousands of employees, thousands of offices and locations. And so trying to get them to change direction in what they do, it's kind of like trying to turn the direction of a super tanker, but in the middle of the Suez Canal. In other words, it's really, really hard. No one's going to doubt or debate whether AI is going to have a role to play in auditing. But I came away from this paper, and my comments are going to focus on this. I think while this is a great starting point, we're missing a bit of the story that I think is really important. So let me just summarize your results. As an accounting firms add AI professionals, good things happen, right? We see an improvement in quality, measured a couple of ways, but mainly in restatements. We see that audit fees can go down. We see that the average fees for accounting personnel are higher, and that accounting firms can actually employ fewer accounting personnel. Just a couple of your main subsequent tests are that the results are not different for Big Four and non-Big Four firms. They don't seem to be driven by AI hiring in the clients themselves. We're going to talk about that in a minute. And the primary effect is at the national office. And that's pretty clear as you look at the concentration of where these people are going to work. Okay, so what I'm going to do is I want to talk a little bit of history because I'm old and I can do that. This is not the first time we've seen shiny new things brought into the audit world. Sometimes they work, sometimes they don't. Once I've kind of laid out the history, I'm going to talk about the economics of what data-driven risk assessment has done over the last few decades, and talk about where we are today and how it might affect costing and pricing. Then I got a few kind of one-off important points and a few that probably won't have time, not important points, which I'll share with you probably offline. So let me start off with the shiny new things in auditing. Yeah, I've been around long enough. In the beginning, basically, it was auditor instinct. That's how we identified risks. In the 70s, we got analytical review. We began to bring in regression models, which is I cut my research teeth on that back in the 1980s, doing those things. And then we see a whole list of very interesting, fancy words that have appeared in our literature, obviously leading up to our more current terminology of machine learning and artificial intelligence. This has been an amazing progression over time, as everyone kind of understood this is something we need to do, but we can't. All these techniques have a couple things in common. One, they've always been a focus on identifying anomalies in accounts, transactions, or other data that would help the auditor to spot and identify risks that need to be focused on during the course of the audit. Okay, the purpose of all these different techniques has not really changed. What has changed, of course, is the technology and the cost of using the technology. But in order to use any of these things, you need to meet a few conditions. One, you need accessibility to client data, reliable client data. You may need accessibility to public data. You need validated models to use that actually can be used by generally untrained, meaning non-AI people. You need the systematic training for the implementation, and then eventually you have to make the economic case for using them, right? And so these things all have to come into play at some point or another. And if you go back 20, 30 years, obviously, even the first two bullet points were very, very tricky. I would argue the first bullet point is still very tricky. Public data is easy, obviously. We've got so many databases out there. And the models have certainly gotten much more sophisticated. But the other side of that sophisticated models is the training's also gotten more complicated. So how do you make the economic case to bring these in? So in the end, right, I would observe, and I'm not saying this is where we're going, but where we've been is that the impact has been relatively minor. But it is pretty clear to me that it is increasing. So the context is not new, but the technology is. The effect of technology almost is always overpromised, but under-delivered. And so the question is it going to be different this time? I think there's some chance that it will be different, at least incrementally different. So let me talk about the role of data analytics and auditing. First of all, I'm going to object to the way you wrote this. Auditing is not a standardized task. It has standardized bits, but as a whole, I don't believe it's standardized. Why? Because every client is idiosyncratic. Every audit follows a framework, but it's not a checklist because it has to be customized to the client. Furthermore, auditing is a cooperative exercise within the financial reporting ecosystem. The auditor is not working in isolation, and they're not imposing their models on the client directly. The risks that we have to deal with depend upon these stakeholders and these other players in the financial reporting ecosystem. And as I just said, essentially what an audit is it's a service that is customizable to fit the client's needs. Okay, so new techniques, technology, and skills often require incremental investments, plus ongoing costs of maintenance. And I'm going to come back to that point in a minute. So the standardized framework that we talk about, and I agree with, is not necessarily the same as a standardized application. And so while you can build the tool, how it gets used is a little different, and it comes down to what's it going to cost. Okay, and I think in the Law and Shen paper, they make actually a couple comments that I think are contradictory to what you say in your paper. I don't think that paper is published either, so we'll see how it all plays out. Okay, let me use a really, really rudimentary economic analysis to illustrate what I'm talking about here. Okay, what's the cost of an engagement? Well, bigger engagements cost more. Okay, that's easy to know. Every engagement's going to have a fixed cost. Now, we almost never talk about this, but we know it exists. Why? Because it's in the billing rates. It's built into the hourly billing rates used by the firms to figure out how much to charge for the personnel. So it's there. Whatever it is, it's there. We don't know what it is, but it's there. We do talk a lot about variable costs, though, and we're almost always focused on the variable cost of labor, right? And so the bigger the engagement, the more hours, the more people, the more time, and those variable costs are going to increase. So, I mean, this is really simple. Economics 101, day one. You get total cost curve, and then you get a fee curve. And somewhere in there, if we're assuming perfect competition, which the audit fee models always do, that fee is going to be essentially cost plus markup. Now, there are a couple, even at this low level of complexity, like simplistic level, there are some issues. For example, you talk about sticky fees. But what about episodic pricing, which occurs whenever a client goes to tender, right? So we have this nothing changes, nothing changes, nothing changes, and then everything changes because they go to tender and they bring in a new audit. But maybe more importantly, if you look at the audit fee model, which you use in some of your analysis, the audit fee model relative to the graph I just drew, it drops fixed costs entirely. Although Dan Simonik right now is working on a paper to bring fixed costs into his model. It adds a contingent variable cost for future losses, and it completely ignores opportunity costs, meaning what is the alternative use of the people that are assigned to an engagement. Okay, so that's fine. That's where we are today. But that's focused on the engagement. And I think given what you're trying to do and what I think the firms are trying to do, we actually have to go up a level. We have to start talking about what is this going to do to the cost structure of the firm, right? Because in some ways, this is a classic trade-off of labor for capital or vice versa, right? And so you have the fixed costs, which is independent about the number of engagements given some relevant range of time. And so you have the fixed costs related to IT and other forms of overhead buildings and all that kind of stuff. But what we often also forget is labor at the firm level is also a fixed cost. Why? Because we don't have day laborers in audits. We basically have a head count. At the engagement level, the cost depends upon how many hours somebody works, but at the firm level, it depends on how many people you have. And so the question comes up is, as we move to this world of higher capital investments, and AI being one good example of that, what's that going to do to our cost structures? So if we look at the firm level first, and we go back down the engagement level, okay, we're probably going to see some increase in fixed costs related to IT and overhead. If we look at the fixed cost of labor, we're probably going to see, hopefully we're going to see some decrease in those costs over time, right? To offset what is happening with the investments we have to make in AI and other technologies. What does that do to total costs? Well, it's not clear, right? Total costs could be going up or down. I mean, I've drawn it one way, but it could go up or down because it all depends upon what the marginal rate of technical substitution is in this particular activity. And we simply don't know that. We don't know that. And then you throw in fees and it gets even more complicated, but that's not what we need to talk about right now. Uh-oh, what's happening? Advance. There we go. So if we now take that and bring it down to the engagement level, right? What do we got? Okay, we've got our fixed costs. This is the original fixed costs. Presumably those higher firm fixed costs are now going to get rolled into the hourly rates that they charge for personnel. So that's probably going to bring up the fixed cost portion of the audit itself, right? For the variable cost of labor per hour, it's going to flatten that, presumably, because you're going to have fewer people. And so that would drive down, or fewer hours possibly, and you're going to drive that down. So that when you add these costs together, your total costs also will flatten a bit, right? And so you have a different cost structure. And then you bring in your fees, and that's what I had from the original graph. Is it going to change? Well, there's an interesting question, which I'll come back to in a second. Will those fees change? So the bottom line is that is the economics, while that's a really simplistic explanation, it shows that the dynamics are pretty complicated, I think, within these massive firms. So pricing depends on market forces and the relative price elasticities, which you don't really consider, which I don't blame you because almost nobody does. But why would an audit firm voluntarily pass on any or all of the savings to a client? It probably depends on market conditions, which you could probably test. How does the audit firm generate the free cash flow necessary to develop these techniques? I don't have a suggestion there, but that becomes actually a very big issue when we talk about audit-only firms in regulatory structures. Is the effect transitory in a competitive market, right? Is everybody doing this simply to keep up with everybody else, right? Or I mean, the only reason to do this is not fall behind. That gets to some relative rates of change, in my opinion. Does the AI investment create a sustainable competitive advantage? And does it actually increase revenue per accounting employee? Is that really increasing efficiency, or is it simply reshuffling your employees? So these are questions, I think, that, you know, whether you can answer them or not with the data is, the more of these you can answer, the more we can get from the paper. Finally, according to my clock, I got about a minute. So let me just hit a couple of important issues. One, the magnitude of the hiring. If I'm reading the tables right, and I'm not absolutely sure I am because they were a little confusing, but basically the average number of hires is 49. EY, Deloitte, PwC, and KPMG are around 100, but everybody else is really tiny. Grant Thornton only has 7. And so when you take those percentages and apply them to the number of headcounts for these firms, you get some, you know, very few AI employees coming in. And in fact, over the decade, the profession added over 1,000 AI employees, but they also added 45,000 audit tax employees. So when you're talking about rates of change, it makes it sound like they're really like gaining, and they may at the margin be, but I think the descriptive results actually give some context here. And then given the rates of hiring, could this in fact be driven by some other issues going on? And a couple I would point out is this really simply a result of the pressure to improve audit quality? You could look at inspection reports, for example, to see how it affects these firms. Is it the marketing pressure and the nature of the client base? Do different client base, I mean, we do know from some work I've done that different clients cluster with different firms. So these investments may in fact be related to their client base. The one thing you looked at, I thought was really cool, but I'm not sure it means what you think it means, is that the link between the client investments in AI and the auditor investments. I really wonder if what the audit firm can do is contingent upon what the client is already doing or has been doing in the past, and it may not show up in the kind of contemporaneous data you have. Because that's the one thing we have learned over the years, that you cannot do this if the client's not ready for some of this. And then I'd need a whole another 15 minutes to talk about the audit fee model. So I'll just leave it at that and stop, and wish you very good luck with this paper. I think it's really interesting, and I commend you for going into an area that we have not spent enough time talking about. So that wraps up. I'll wrap up. I'll send you everything else separately in an email.
Thank you so much for that outstanding discussion, Robert. Amazing comments. And thanks to the audience for all of your thoughtful questions. And there was, I've been busy over here trying to merge themes. There's a lot of common themes going on. And Robert, a lot of your comments also resonated with our conference participants. So let's see. I have color coding, fortunately. First, let's see, Jan Bowens at University of Amsterdam was thinking about investment in people, and this also came up a bit more as well. Jeremiah Green from Texas A&M. So to what extent do firms kind of also need to invest in these auditors? Like what sort of junior auditors are they needing to hire in order to use these sorts of tools, like the skills needed to operate these new technologies? And should that also kind of shape the training that we have of these graduate students who are going into auditing? Did you hear anything from the firms about that in your interviews, for example?
Absolutely. Yeah. So that was actually one of the themes that came up a lot. So when we take a look at kind of in the resumes, these AI workers, already there in their job descriptions, we see they focus a lot on actually improving the process and building these predictive models, but some of them explicitly mentioned also running training programs, running kind of some of these centers that also kind of help the digital transformation of individual auditors. And we heard this from, I think, the majority of the audit partners that we spoke to when we asked them, what is the kind of highest barrier to implementation of these new technologies or the largest cost? By and large, they say the computing power, that's relatively cheap. So to Robert's excellent point, the fixed costs of IT, right, would increase, but they're getting cheaper and cheaper. So the effect is getting smaller. Data, well, yes, that's in the hands of the clients. So the auditors can try to build better systems to which they can plug in the client data, but ultimately the data is what it is. But the human capital is the single kind of main barrier, both to actually be able to adopt these algorithms or even develop or kind of implement them in-house, but also, and this is something that it got mentioned even more than we anticipated, to train the individual auditors to be able to use these tools. And it related to the point that Robert made very early on, kind of in his big picture comments before going into the specific discussion. These are large firms that are right, kind of used to doing things in a certain way, and implementing big scale changes is something that is a challenge. What we hear from audit partners is that there is a really big effort to do that. So these kind of centers for excellence and innovation and so on, when they develop the tools, there is a concentrated effort from firm management to deploy those tools in individual engagements. But there is some pushback from especially older auditors and kind of the younger auditors that are getting hired in the firms now are the ones that are more eager to experiment with these technologies, and they do more frequently possess technical skills themselves. So I think we will see a transformation of the broader workforce.
I can add a note to that. Auditing is a service process. It's not a production process. You can't just shut down the factory floor for a couple of weeks and retool everything. And the firms, I mean, for those of us who are at state universities that are essentially feed the CPA mill, the firms at the big four anyway are hiring no more than probably 50% of their entry level people are coming out of accounting programs now. They're coming from ISOM or wherever. And I suspect those people are not actually necessarily in your data set because they're entry level. And so you may actually, in fact, be underestimating how many people they're bringing in with those skill sets.
So they are actually, so the coverage, the 80% coverage is across the board. And so yeah, we do see kind of younger as well as older employees, because the labor data is from Cognizance. It's not from any of the audit databases, but just from resumes. And I think those people are also likely to have LinkedIn profiles and so on, from which the data.
They're not entry level starting 21-year-olds, probably.
Yes, and actually Eva Labro from UNC Chapel Hill had a thought that was related also to these two different types of employees at the accounting firms. So she was interested in learning if the productivity of the entire set of employees, so including both the accounting employees and AI employees, is improved. And she thought that you could calculate that via audit fees divided by the total salaries paid. And then she also commented that the salaries of the AI engineers are quite a bit higher than the junior auditors. So her observation was that overall efficiency would depend on how many of those AI engineers the firm needs to hire to make those junior auditors more productive. So do you have any thoughts on that?
Yeah, that is a really good question. So I'm less familiar with the salary data, so I think maybe we can chat a little bit afterwards about what sort of the best ways to measure that is. But for sure, the salaries of AI individuals are disproportionately higher. So also related to something Robert mentioned in terms of the magnitudes, right? These are few workers, right? It's like 1,000 in total at the firm. It's a proxy, right? If the firm is hiring 10 of them rather than 5, it's a proxy for whether the firm is serious about implementing AI efforts and whether they have a group that is developing the methods that then the thousands of auditors will use. We think of them a little bit like inventors at firms, so patent holders. I think the percentage of AI workers is similar to the percentage of patent holders across many industries, who are also disproportionately high paid and kind of bring in the innovation and then get used across the firm. But yeah, I think it's a really interesting point to factor in their salaries into the cost structure as well. So I'd be interested to hear more about good salary
I think
data.
Ava's point is absolutely correct, because I just saw a report, I'm not sure how accurate it is, but basically saying that starting salaries in Big Four firms today are the same as they were 20 years ago, ignoring inflation. So, you know, what is that saying about the marginal value of product, or the marginal productivity of their time, when you have seen, when those are what you're getting paid?
Yes, yes. And in addition, also, Robert, with respect to your comments on the client data and our thoughts on the accessibility of that theme also came up a few times. And I personally, to pipe something in, I thought it was very interesting to think about to what extent these tools are configured to kind of work with the client data, because like Robert said, the clients are all very unique and their data is probably all unique. So to make the most effective tools, it could depend on how much you can kind of customize the tool to the client, but then that increase the cost. So it'd be interesting to see if like the audit firms pass those costs on to their clients, like do they charge for the IT, the tool? And then that kind of goes up to Frank Zhang from Yale, brought up if firms are acting rationally, in this case, by investing in AI, and thought that kind of ways to bolster the tension could also be helpful. And I think that could be one way to bolster that tension. And to Robert's point, like it might be very costly to effectively generate these tools and use them.
Yeah, so what we hear from the audit partners with respect to kind of client relations is that clients want to see AI. So oftentimes this is something to bring in a new client. Mm-hmm. This is something that audit firms highlight their use of technology, so it's attractive to clients. But several auditors have highlighted that, at least in their experience, the clients are not that sophisticated about AI. So they like to hear the buzzword, the shiny new things, as Robert put it, but they don't really understand what it takes to do an audit, what kind of is feasible, what is helpful. And so this is why we think that our results indicate that kind of the fraction of clients, workers who are skilled in AI is not necessarily predictive of audit outcomes, basically. That it's really the auditors that know how to implement new tools in audit. And clients appreciate that, but are a little bit behind in terms of how it actually plays out in the audit process.
Yes, yes, so interesting. Also, so some questions came up about restatements. For example, Po-Chang Chen from Miami University brought up, if audit firms use more AI talent to help build these predictive models of fraud, would we maybe expect to see more restatements discovered, like if these tools are better at detecting fraud? So I was wondering if you had any thoughts on that.
Yeah, so our interpretation is that they're better at doing it in a timely way. So they detect the fraud in time of kind of the initial audit, rather than for it to come up further down the line. And one of the auditors we spoke to made a really interesting, I guess, description of what these tools are doing. So like it really allows us to catch things in real time. So instead of doing, just that kind of once a year really big effort of the auditing, we're actually, if we're plugged into the system, if we're able to monitor the data and use these predictive technologies, we're able to detect things more real time rather than just at the time of the audit. So that's my interpretation of the restatements going down, is that they are making better detection and they're doing it in time for the initial audit.
Oh,
yeah, if you want some tension here, I mean, this is, you're absolutely, everything you said is absolutely correct. But then there's the reality. When you give up sampling, which is what we've generally used for many things, and you start looking at the entire forest, you start, instead of getting 3 or 4 exceptions or anomalies, you get potentially thousands of anomalies. And there's all kinds of decision-making issues involved, because the anomalies don't necessarily mean errors. They just mean things that don't look right. And who prioritizes those, who clears them. And now that you're no longer sampling, how do you roll this up and project it to the account balance in its total? I mean, these are very practical audit issues, but they're very real. Yeah. And during the time when I was working with the PCOB on some things, this was an issue that they were really focused on, because this could drive the cost of an audit through the roof. And that's obviously
actually
not
what we hear from some of the auditors who I think are kind of a little more sophisticated in terms of use of the tools, is that it doesn't necessarily replace sampling. Instead, they use it to better guide their sampling. So instead of taking a random whatever percentage of transactions as a sample, they now take the ones that are deemed higher risk, but not necessarily replacing the human element of the sample.
Thank you so much. And thanks so much to the audience for all of your thoughtful questions. We will definitely send those to Anastassia and her co-authors. And just want to thank you, Anastassia, for a really phenomenal presentation. And Robert, thanks for that amazing discussion. And now I'll pass it over to Patty.